Hey guys, I'm Phil Town from Rule 1 Investing, and today I want to tell you how I'm waiting right now for the next stock market crash. Most of the time, successful investing is a waiting game. Charlie Munger said, you don't make money when you buy stocks, you don't make money when you sell stocks, you make money while you wait. So just as there are poor times to sell your stocks, there are poor times to buy them as well. And sitting on money, on cash, while you wait for a better opportunity to buy a great company on sale is often one of the best investing decisions you can make. At a time when most investors, encouraged by the strength of the market, how it's going up so fast, are pouring money into the stock market at an unprecedented rate, I am personally sitting on the sidelines more and more every day in cash, waiting for the next stock market crash. We're going to talk about the reasons why I'm waiting for the next crash before investing heavily, as well as why I believe that I won't have to wait very long. First of all, the current market is screamingly overpriced. There are a range of factors that have led to an enormous surplus of cash flowing into the US stock market. First and foremost is the optimism lately about its current strength, because it's been going up for 10 years, which has encouraged investors to ignore the high valuations and put increasingly large amounts of their money into the market. Other factors leading to a ton of money going into the market and thus overpricing valuations include a big time lack of attractive investment options elsewhere, right? Where are you going to put the money? Bonds are like on their way down. So index investing also, which drives companies up just across the board because people are just buying the whole index. US policies such as tax reform, which have encouraged individuals and companies alike to put more money into the market. Companies taking that extra dollars from tax reform and buying back their own stock, driving their stock up. Companies taking low interest rates, borrowing money at a rate never seen in history. Corporate debts beyond, ridiculously high right now, in order to go buy up other companies, which drives up the stock market. So the result of all of this artificial, cheap money moving into the market, people starting to follow the market with greed, is enormously high valuations, which make it difficult to find a company with any kind of good margin of safety price. The prices are so high in the market right now that based on the Shiller PE, they have only been this high twice in the last 140 years. Are you sitting down? 140 years? The first time they got this high was 1929. Take a note, 1929. And the second time it got this high was 1999. So we will not be here long. And as Rule 1 investors, we try to invest in companies that have at least a 50% discount from their real value, a 50% margin of safety. So that means that there's at least a 50% upside between the company's price and its true value. When valuations are as high as they currently are, man, it is almost impossible to find high quality companies that exhibit any sort of margin of safety at all. Most of them are triple or quadruple a margin of safety price. That's pretty sobering, but let's go deeper. Next, the smart money is staying on the sidelines or starting to move to the sidelines. Following smart money. Now, okay, what's smart money? This is money from big time investors who know the market better than anybody, who are the best investors in the world. People like Warren Buffett and Charlie Munger. Following these guys is rarely a bad idea. And right now, these investing gurus aren't putting money into the market. Instead, the majority of the money flowing into the market right now is coming from dumb money, retail investors, people that just don't know what their choices are. Buffett currently has $116 billion in cash. That's more than double than he has ever had in cash at any time in his entire 60-year investing history. You might want to take a note. So let me define retail investors. These are just everyday mom and pop individuals, right, who are not knowledgeable about investing, and they're handing their money over to the financial services industry, expecting the financial services industry knows how to invest it. But I got some bad news. The financial services industry predominantly works off of modern portfolio theory, which tells these financial investment professionals that price and value are the same thing. Now, this is being rapidly debunked, and Warren Buffett's been saying it's nonsense for 60 years. But most of your money is being invested according to a theory that says that price and value are the same. Therefore, you don't have to worry about the price of a stock. That means your money's going into the market, just pouring in regardless of the valuations of those companies. These professionals are going to pour the money in based on some investing strategy that we call momentum. If the market's going up, optimism is high, they're going to pour the money in no matter what the valuations are and just ride along with the market. Now, this power of the individual money you think is not a lot, it's everything. It cracks me up when we talk about the 99%ers and the 1%er. The 99%ers out there in New York were complaining about the way the 1%ers were handling things. Well, guess where the 1%ers get the money? They get it from the 99%ers. In fact, it's almost that high of a percentage of money in the market. It turns out 85% of the money in the stock market is little guy money being managed by dumb big guy investing strategy called modern portfolio theory. So this collective spending power is just enormous, and it continues to drive the market higher and higher and higher to valuations that are now approaching record levels. Now, while these retail investors are buying stocks faster than ever before, some of the smartest investors in the world are pulling out of the market. Now, this is a pretty good indication that right now may not be the best time to buy into the market. A couple of people you might want to take a look at online if you want to run a YouTube video is Ray Dalio, who runs the largest hedge fund in the world, $120 billion at last count. And Ray is basically saying we got a 70% probability of going into a huge recession with a market crash in the next 24 months. Pretty intense, right? Third, a crash in the market is an excellent opportunity for you to load up on businesses you love. And that's why people like Buffett are going into cash. They want to have a giant wash tub when it starts to rain gold. And when this market starts to go down, that rainstorm, that market storm that's going on is raining gold for those of us who have cash to buy stocks with. Stock market crashes are not negative things for investors all the time. In fact, if you have a lot of money in cash, you're basically what Nicholas Taleb calls anti-fragile. The idea that a huge problem or crisis can actually make you stronger. So when the market goes down, crashes like that present an opportunity of a lifetime. It's pretty cool that throughout history, the bear market that follows a stock market crash has rarely persisted more than a year or two before the market bottoms and off it starts to go. Meanwhile, these bull markets last many, many years. Usually we have some sort of bear market every 5 to 10 years with an average of about 7, and we are starting into year 10 right now. And what this means is if you're careful about being patient, you're going to be able to buy great companies at really low prices following a crash, and you're going to be in that market for many years of gains. This is where the Buffetts and the Mungers of the world get gigantic rates of return. So if you have all of your money in the market before the crash, though, you won't have any cash available to buy cheap stocks following a crash. Then you'll be doing what Buffett laughs about. He says, when it's raining gold, you're going to go out there with a thimble. That's all you're going to have. You want a wash tub. And this is why sitting on your money and waiting for the crash, when valuations are as high as they are right now, can be an extremely effective investing strategy, even if it takes years before the market crash actually happens. As rule number one investors, we are likely to find companies that are solid enough to survive and thrive no matter what the market does. In fact, we should pick ones that do great when the market crashes or when we're having a recession. When a crash such as the one that's very likely on the horizon drives the price of these companies down, the opportunity for great returns is higher than any other time in the market. It's pretty exciting that you're getting close to an opportunity where you could get rich if you really know what you're doing. Now, I'd love to hear from you guys. Do you think we're headed for a stock market crash? And what will you do if there is one? So leave a comment below with your answer, and I'll be sure and follow up with you. This is fun stuff. Really appreciate you watching. Now go play. If you guys enjoyed this video and feel it was valuable in teaching you more about how to deal with a stock market crash, hit the like button and please share this video with your friends. And if you want more investing content, subscribe to my channel. And don't forget to click on the button on the screen for a free gift. It's awesome. And thanks again for watching.